Welcome to Multifamily Method, a podcast which explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide.
This is one way of seeing it, but you have to go a bit above and look at the bigger picture. Look at the economics, look at the economy in general, look at the fiscal economy, look at fiscal policy, look at the demand, the internal migration within the US. But just looking at real estate and not taking a few steps from above and looking at it from, 10,000 feet, you're going to miss a lot of opportunities. You can also miss a lot of red flags. It's really, really important to understand where you live and what's going on with the economy, with, politics before you make any decision.
Welcome to the Multifamily Method, a podcast that explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs. Hi, I'm Alex McDermott, host of the Multifamily Method.
And I'm Jad Risha. I'm co-host of the Multifamily Method. Today, we've got our special guest host, Tyler Hogan from our Atlanta office, and our featured guest, Ellie Perlman. Ellie is a real estate investor who owns multifamily across the United States and is the founder and CEO of Blue Lake Capital, a real estate investment firm specializing in multifamily acquisitions. Ellie has an interesting background which has contributed to her success. She started her career as a commercial real estate lawyer in Israel and transitioned into a property management role where she oversaw properties worth over $100 million. Today, she's the executive at Blue Lake Capital, which has grown to over 2,300 units and approximately $320 million in just 4 short years. Ellie holds a master's in law and an MBA from MIT and is also a Forbes author and host of the Ready to Scale podcast. Thanks for joining us and welcome to the podcast, Ellie.
Hey, I'm doing great. Thank you so much for having me today.
Yeah, glad to have you with us, and thanks for taking the time. Today, I wanted to discuss a little bit about your background, your experience, and your journey in commercial real estate, specifically in multifamily, and what's led you to the success that you've accomplished today and what you have planned for the future.
Where do I start? Well, I'm Israeli. So back in Israel, I was born almost 39 years ago. I was born to a very religious family, and there were, money was not something we had at all. We were getting some assistance from the government, and we tried to get by. It was pretty tough. And when I was 10 or 11, it was the first time that I actually understood where I was compared to others and what we're going through as a family. When I was 10 or 11, I used to clean synagogues just to help my parents, make a little bit of money. And so at that point, I kind of started realizing that I have to create a better future for myself, and I need to somehow, in some way find out my own path so I wouldn't have to live the same lifestyle or lack of back then. And so, fast forward when I was about, in my early 20s, I said, I was always fascinated by real estate, but I had this misconception that many people have today, which is you have to have a lot of money to get into real estate and to buy assets. And, I didn't have any money. All I had was my brain. I used to study really hard. I really enjoyed it. It's we didn't have TV in the house, and what I had, in my spare time, I was actually reading books and newspapers, and I found it fascinating. And so I worked really hard at getting to law school because I thought, okay, what do I have? I only have my brains and I don't have money. So I should, and of course I took huge loans to get into law school. Worked really hard for 4 years, had zero social life. Back then, I just spent every single for minute that I had, either work to pay for my college tuition, or write a paper, study for an exam, whatever it takes. That was my motto, whatever it takes. Got into business school, got into law school, graduated, and I was accepted to a really good law firm and started to work at the real estate, part of the real estate team. And I worked on huge deals, deals that were 20, 30 million euros in Europe, Eastern Europe. It blew my mind away. I've never thought, I've never worked on something so exciting, projects, communities, office buildings, a lot of really interesting things were happening. And I wanted to be, now that I wasn't poor anymore, I was looking at the next step, and I wanted to be my clients. I wanted to be the investors that are buying assets rather than the lawyer that is negotiating on their behalf. I saw how much money was exchanging hands, and I felt that I was on the wrong side of the table. And so again, I went back to education, and I said, and that was still in Israel. I think it was my late, 20s, 28, 29 years old. And I said, I want to go to America because I remember from school the self-made men concept. And I told myself, I'm going to work hard. I know I can make it. It's going to be harder in Israel. It's a small country, smaller opportunities. I need to be in the States. And then I said, okay, I'm going to move to the States, but I need to have something that is going to give me another edge. And that was business school for me. So, not choosing the easy path. I wanted to go to a good school, and MIT was one of the schools that I chose because they had a really great entrepreneurship program, part of their MBA program. I wanted really to learn how to start businesses, how to buy real estate, how to attract investors and raise capital. And this was all this education I got from MIT. After graduation, moved to California, and shortly after, started Blue Lake Capital. And today my company buys and operates multifamily assets across the US, normally 50 to 120 million. That's kind of the deal size that we're, doing today. And we work with investors, with family offices, with institutional investors to basically close deals.
That's incredible.
Yeah, that's an awesome story. There's a lot to unpack there for sure. So you mentioned why you came to the States. Why California?
Because it was warm. There's no other answer. That's the truth. It was warm. When I was in Cambridge, I think it was the hardest winter in 100 years on record. I've never looked through a window of any apartment and I've never seen people skiing in the streets. That was an extreme. Yeah. And that was the first year moving from Tel Aviv to the US. I had to learn how to even walk on snow. I didn't know it was a thing. I thought, if you're all bundled up, you can just walk and it will be fine. And it's not. You really need to learn how to walk on snow. Cars that are completely covered by ice, not something that I've ever experienced. So I just wanted to be far away from the cold. That what brought me to California.
That's why I'm sitting in Tampa today. So it's I think you're a smart
guy.
Yeah.
Spent too much time in Cleveland.
That's right.
You mentioned that when you were 11, you started cleaning synagogues to help make money for your family. Right. To me, that sounds like your work ethic started out at a young age. Was there any reason other than necessity? What drove you to have that work ethic that you've continued, obviously, through where you are today and continue to have?
I think my parents played a significant part of it. They didn't have any money to give me, but they gave me something that was worth a lot more than gold, and that's discipline. From a very young age, we had a chart that my mom used to put on the fridge. There were 3 girls and 1 boy, and we're not going to get into the conversation of why my little brother was not part of the daily chores, but there were 3 chores and we were circulating the 3 girls, and there's no way out of it. There are no excuses. You need to, take care of the laundry or, make dinner or whatever it was. And if I didn't feel like doing it, I couldn't just cry to my mom and say, I don't feel like doing it today. I had to trade it and negotiate with my other sisters, either bribe them with a toy that I had and then they didn't, or switch with them or give them some sort of do some sort of a favor so they'll take it from me. I think that really contributed to this. And then the other part was my parents kept telling me my entire childhood, there's nothing that you cannot do. You can do whatever you want. You're going to reach the stars and you're going to be, amazing. And I believe them because I was a kid. Who would I listen to if not my parents? And if they say I'm that amazing, why would I not believe them? And I think that mindset kind of, it's there. And it's always, I think, in the background, really believing that I can do whatever I set my mind to, and whatever, ridiculous goals I have in mind. I have many people raising their eyebrows and saying, that's a stretch, getting into MIT. People didn't think I can do it. Not only I got in, I got a scholarship, doing a lot of things along the way that people said, I don't know. It doesn't make sense, leaving Israel and going to the States. Who does that? Just live in the middle of, without any, job to back it up. So
start negotiations early. Help lead to the law school, right?
There's no other way. When, sometimes I think when you're in a certain situation, you don't really feel how hard it is. Looking back, you say, wow, that was challenging. But when you're in it and you don't really know any other reality, it's just life. It's not harder or easier than any other average life. That's how that was my experience back then. So
I want to go back to something you just said. You said that your parents instilled in you that there was nothing that you couldn't accomplish. And Alex has 2 daughters and I have a daughter. So we like to hear that because it's obviously manifested itself in success. You are a female in a male dominated industry. So sticking along that concept, like how has, not so much them telling you that, but what has your experience been working as a female and being successful and accomplishing tremendous things in a male dominated industry?
I'm not going to give you an easy answer. It's not a popular opinion. I don't care about men, women, aliens. I never saw myself as a woman in a male dominated industry. This is BS because when you're thinking about it and it's got nothing to do about how hard it is for men or women or minorities or whatever it is, it gets in your head and you're going to start, instead of being accountable and pushing hard, you're going to find excuses. Oh, I didn't get that deal because I didn't get that job because, I'm a woman or I'm not white or whatever it is. Maybe not a popular opinion, but it never bothered me, not for a second. I never said, I'm a woman. I don't know if they're going to accept my offer or if they're going to, invest with me. If you have that even in the back of your head, you're going to act on a conscious and unconscious level in the way that it's going to just stand in your way. I don't think about it. I don't, it doesn't matter to me. I never saw myself different than any other human being in the industry. So I honestly, you're saying it's a male dominated industry. I don't really see it. I see people. So maybe not a popular opinion, but I don't want to victimize myself and think of myself, at a lower kind of, coming from a lower place or a different place. It's not something I think about or consider at any point. So.
I think that's a great response and a great mentality to have.
Yeah, absolutely.
For anyone, right? So I think that has probably helped make you successful throughout your entire life, as well as your discipline and work ethic. So I guess let's jump a little bit ahead and speak about Blue Lake Capital. You moved to California after MIT and you started Blue Lake. What was the catalyst? What was the goal? How did that all come to fruition?
So before starting Blue Lake, I was actually a very comfortable tech employee, made six figures, and it was the easiest job that I've ever done and the most uncomfortable thing that I've ever done because it was a bit too easy, meaning I didn't have to fight for my place. You go to work at 10, you leave at 4, you do more than they give you, you do more than you're asked. And you're always, I think maybe it's a cultural thing always to push and do things beyond what is expected of you. And at some point, I started to look for other things, and it was a little scary. I have to be honest with you, because I've been fighting my whole life to get into a certain place financially. And when I finally got there where I can buy whatever I want, I wasn't worried about paying rents or paying bills, which were still an issue even when I went to business school because I had a huge loan. Finally, when you get to that place where you say, I'm comfortable, I'm out of debt, I'm good, then you start feeling uncomfortable. I started feeling uncomfortable very quickly, and started to listen to podcasts and reading books about investments, about real estate, about startups, and very quickly found myself attracted to real estate again because, I started my career as a real estate lawyer. Started to go, to attend conferences, and I was thinking about fix and flips. I was considering, buy and hold and other strategies, and realized that they don't scale. And I wanted to scale, I wanted to grow, and I wanted to start a company and grow it. And so at some point, I took my MIT education, and I also got education specifically around syndication, how to really craft a message to investors, how to do value add, and how to analyze financials. And some of the basics I had at MIT, but MIT doesn't teach you, and I love MIT, but they don't teach you how to take a losing property and make it a profitable property, and how to push income, how to cut costs and retain the best talent to manage your asset. So I went back to education and educated myself and started, Blue Lake. And that was in short, my path from graduation to basically starting Blue Lake.
What year was that?
That was 2017.
Okay. So in 4 years, you've accumulated 2,300 units.
Yeah. And I should have had more. So it may look impressive if you're looking at it from the outside compared to the goals that I gave myself. I'm way behind. But I'm sure you guys know it's really competitive out there. Yep. It's not a problem to overbid and get a deal. That's the easy part. The hard part is, okay, now you got the deal. Now the real work starts because you need to provide the projected returns to investors. So I was very hesitant to, just buy more and more and more deals. It had to be the right deal. And as you probably, know, it's most deals, don't work compared to, the kind of returns that I'm setting up, the goal that I'm setting up for myself, for Blue Lake, for investors. So I'm buying slower than I thought I would have. And it's just a function of the timing. When the timing is right, we get a deal, and when the timing is not right, we're either waiting for the right opportunity and just buying a little bit slower. On the flip side, if it's harder today to buy an asset than it was 3 years ago, then it's a fantastic time to put deals on the market and sell them. And that's why, we're also sellers, and right now the market is just booming. So, you have pain on one side and then you have gain on the other. So it's just interesting to be on both sides of the spectrum.
Well, it's also important to be disciplined, right? Where some groups will just go out there and they'll take whatever down. It doesn't matter the price. Well, you have to promise, you have investors, you have a fiscal responsibility to those investors, and reputation's everything. So if you're not providing that, then you're not going to get investors back, and you're not going to be able to buy deals at all. So
exactly. That's exactly right.
All a part of it. 2017, you started it. How long from inception of Blue Lake did it take for you to get your first deal? And then also, were you still working the tech job while you were starting Blue Lake?
No, I was not. I knew that if I'm going to keep a job and run the company, I'm going to be distracted, and it's not going to grow as fast as I want. And I had to burn a bridge and not have a job and focus 100% on Blue Lake. So I was actually 100%, 1000% committed when I started, and it took me about 6 months from the day I started Blue Lake until the day that I closed, the first deal. And during those 6 months, it was basically the time was spent on hiring the right people that can underwrite deals, hiring an admin, so I don't need to schedule meetings, and focus my time on reviewing deals with my underwriting team, and also speaking with investors. And those 6 months were good because it was a good prep time to speak with investors, to reach out, to get, lay the foundation. So when the deal is there, you already have established that platform, and you can go back to investors and start raising money. So I started raising money from the very first day, and I'm always raising. Yeah. Every day I'm raising money. And if it's not being wired for a deal, it's speaking with new investors or getting on podcasts and speaking, attending conferences. And so that's a big part of, the business.
So your very first deal, who were your investors? Where did you find them? How did you convince them to invest with you on your very first deal? And maybe what was their, sort of profile, so to speak, for, what type was it? High net worth? What was that pool you pulled from for that first acquisition?
It was not easy because I was not born here. By the time I started, Blue Lake, I think it was in the States maybe for 3 years. So I didn't really know many people. And my classmates were still paying student debt, and they haven't had time to accumulate wealth. Now I'm getting phone calls from my classmates asking, do you have a deal? And then I answer, are you accredited now? And not all of them are accredited. But my investors were, for the most part, people who were kind of like me. So former attorneys, they like to, when they see me, they say, okay, she used to be an attorney. I trust her. I see something, in her that I recognize myself. It was a combination of attorneys and tech executives because of my background at MIT and then in the tech industry. One of those investors were actually also my father-in-law, and it wasn't easy to get him in the deal. He's a very sharp businessman. And, at first, when I came to him, when I said, hey, I'm starting Blue Lake, he didn't understand why I'm doing what I'm doing and what I'm talking about. And I told him, I laid out the business plan and what I was doing. And I asked, if I get a deal, would you invest with me? And he looked at me, and I remember we were sitting in his kitchen, and he said, I've been investing with another company, a very well-known syndicator, for almost 10 years. Why would I invest with you? You're just starting out. You don't have the experience. And, I looked at him and I said, when you started your business 30, 40 years ago, you're competing with the big guys and, of that time. Some of them haven't survived. I'm you just 40 years ago. And I'm sure my future kids I'm building an empire, and one of them is going to manage my empire, and the other one is going to manage yours. So I'm going to do it regardless. And I smiled, and my palms were sweaty, but I was smiling. And he said, just let me sleep on it. And the next morning he came down the stairs and, from his bedroom, and he said, all right, I'll do it. And so he became one of my first investors, but it wasn't easy, and I appreciate it. I don't expect, him to cut me a check just because I'm married to his son. But I would say 99% of the people who are investing with me are people that I've either never met. So people that I've communicated over the phone. Some of them became my friends, but I didn't bring, besides my father-in-law, I didn't bring friends and family to the table. It just happened this way.
That's a huge struggle, right? Finding the investors, getting that first deal done, I'm sure. So after that deal, has it been more word of mouth from those investors telling friends, family, whatever? So, and obviously you have classmates from MIT that are calling you now. So how are the equity raises now? What's that looking like for you?
It's a combination. So it's kind of the network effect where investors are bringing now their parents, their brothers, and sisters, their friends, and they bring more people. And the other part is just, marketing, people that are reading one of my blogs. So I have a blog. If you go to www.ellieperlman.com, there's a blog and free resources for passive investors. And I also write for Forbes. So investors find me on either social media or when they search on Google for multifamily investing, and they read my materials. And so I have, actually many investors are reaching out to me every month. Sometimes it's on a daily basis, and want to discuss with me about future opportunities. So it's a combination of new investors that are reading my content, the content that I put on the media, on social media. And the other part is just from either repeated investors or kind of word of mouth. It's kind of a combination of both.
Well, so you've done a really good job using social media, and you're really effectively a marketing machine all to yourself. I've actually been connected with you on LinkedIn for several months now and didn't even know who you were. And just before Tyler introduced this opportunity to speak with you. And we're starting to see more and more of that in our world is savvy investors and people who are tech savvy like yourself, utilizing social media and the internet to generate capital. When you first started doing it, how early in your process did you start using social media? And did you see anybody else doing it that inspired you to use that route, or did it just grow organically?
Started investing in marketing from the very first day. We normally don't pay for ads or anything like that. But one of my first hires were, marketing team members. So they help get the word out. They help, once we have, a new Forbes article or any article, on my personal blog post, on my personal blog, on my website, they make sure to circulate it across the multiple, social media platforms. So a lot of it, I'm not doing. It's my team making sure that I expand my reach to investors. But it was one of the things that I've invested in, getting good marketing, members from the very beginning, because I didn't have an extensive network when I started. I had to use social media to reach people that I've never met and would be interested in investing with me. I didn't have the luxury of going to 5 or 10 wealthy investors that I knew from childhood or from, law school and ask them to join an invest. I just didn't have that. All I had was social media. So I'm just using, every situation, I'm just using the tools that I have. And, it's also, I'm trying, I don't like to do the hard sell. I don't believe in the hard sell. So, if you paid close attention, you'll see that most of, when I say marketing, I mean, putting free content out there, try and help investors, get educated and be smarter about investments. That's what I mean by marketing. I don't mean creating flashy ads and, just distribute the ads across the board and, do the hard sale. I don't believe in it. I think investors are doing a good job vetting sponsors, and I want them to know who I am, and I wanted to know, what I stand for. And you can see that on the articles that I write. And that's why they decide to reach out to me and speak with me about investing. It comes from that. That's what I mean when I call marketing.
Do you think that you're utilizing?
I have a question.
Go ahead.
Alex, just real quick for Ellie. So do you have any suggestions or tips for other multifamily owners? There's a lot of groups that I know that we all work with that do not have a presence. Do you have any suggestions for them to help grow their presence on social media?
Yeah, I would say you can basically divide it to 3 different steps. One is understanding who your audience is. You got to choose kind of a certain type of audience so you can talk to this audience. If you talk to everyone, you talk to no one. That's what I believe. And then try and understand what their pain point is. And the third step is to help them and really create value without the intention or without the anticipation of getting anything in return, at least not right away. So think about the things that they care about. For instance, my investors, lawyers, accountants, and tech executives and entrepreneurs, which I'm, besides an accountant, I'm all of the above, or used to be at least. They're really interested, for instance, on how to transition from a full-time job to a full-time investor, passive investor, and how to vet sponsors. And so I write content to educate them, to help them, and I give them free tools, all kinds of free Excels, for instance. So it makes their lives easier. And so start with a blog. It doesn't cost anything, right? Unless you pay someone, of course, to write it down, to create it for you. But once you understand your audience and what they care about and what their pain points, just write to alleviate that pain point. Give them real value that they can use, and have someone, post it on LinkedIn and Facebook and, Medium and anywhere, you want. So you can start with a blog. Then once you master it, you move to the second platform, which is a podcast. So I also have a podcast ready to scale, and I interview real estate investors, active and passive investors. And so after you master this, you can move to the next one and the next one. Maybe, you write for Forbes. Maybe you start making public appearances and public speaking engagements. And so just choose one platform, the one that is the easiest for you, and then move to the other one. And you don't have to do everything. If you're not comfortable speaking in front of a camera and you're more comfortable writing, stick to the blog, but just do 1 or 2 things and stick to it and master it before you move to the next, platform.
Do you think that your background in being an attorney, and then also anything with your tech experience, has helped you in the real estate sector and with the marketing? I mean, marketing is a huge part of what all of us do. We're all, we're sales first and foremost. We're salespeople here at Capstone, and it's also marketing is how we do our business. Has any of those skills translated over?
Yeah, directly and indirectly. So as a lawyer, we are trained to foresee, basically see all the negative consequences and scenarios and protect our clients and embed it, for instance, in the contract. So when you're representing a client in the contract negotiation, you need to think, okay, if A happens, then I need to have certain, certain mechanisms in the contract to protect my client. And that's how I view real estate, I think, okay, what if this happens? What if that happens? And I'm looking at every deal from a worst case scenario. Now, of course, if you stick to it all the way, you're never going to buy any real estate because you can psych yourself out of every deal. What if the building goes down to 25% occupancy? Yeah, it's a losing deal, but very low probability, right? So you have to maintain some balance. That's what I mainly took from my legal education. And of course, it doesn't hurt with, negotiations. That's, we get things faster because we understand, I understand the structure, I understand the legal terms, and it's just, it works smoother. And then from MIT, I'm seeing, when I started actually Blue Lake, I treated it as a startup. I didn't look at, let's get one deal and then wait for the next one and the next one. It's creating a strategy, a budget, hiring plan from day one, as if it's a startup that we need to scale, that we need to grow, with really clear objectives and goals. And we track them like any startup would. So I basically look at Blue Lake as a company that needs to scale and grow before it's a syndication. And part of growing is having a really strong reputation, and strong reputation comes from very, very happy investors. So I'm willing to sacrifice a lot to make my investors happy. And that's also why we grow. And that's also why, when someone comes to me and says, I want to connect you with my 85-year-old father who's looking to invest, that means the world to me, because he trusts me so much that he's willing to bring people that he cares about. And, probably it's, parents, what can be more precious than this? But that's your question. That's the part that I took from MIT. And also how to raise capital, how to speak with investors. And so, yeah, it's a combination. I think I see things a bit differently. It's not only through a lens of a real estate investor, but as a business owner and as a lawyer. It's kind of it's kind of my brain is. It's as if my brain is kind of divided to 2 or 3 different parts. But it's fun.
I definitely see it through a different lens. And I think that's refreshing too. And I think a lot of the guys that have been doing real estate, especially before, the recession happened, they were buying in the recession or right out of it. And then as soon as, 2014 hit or 2015, it's coming to an end. And so they stopped buying, and they've been on the sidelines ever since. Jad, how many people have you seen that are like that?
Yeah. And now they're like, well, I shouldn't have stopped buying. In 2015, people were caught bearish on the market saying, the pricing's getting too expensive. We're 50, 70%, maybe 100% of, 6 years ago pricing. And, if you understand the fundamentals of what's really driving the valuation, you don't care about the per pound pricing, right? Because, every deal that trades sets, a new market, but that just means the next deal is going to trade even higher in this market. Yeah. Because the fundamentals that are driving it are population growth. And, maybe not everywhere, but in the markets that we're sitting in, that's really where the value comes in. And, I think building it from back to front the way you did is something that is very rarely done in our industry. We did it as a brokerage shop, but only because when Brian and Bo started the company, it was 2009 and nobody was doing any business. So they had time to build the back end out first. But typically, first time investors are showing up with no company name, a Gmail account, and all those things are fine. It does, they can still execute, but they're going to have a hard time accumulating 2,300 units in 4 years because they don't have their infrastructure built out the way you did it. And we don't see that in our industry that frequently.
Yeah. And I think to your point, just investing and then stop buying at 2015, 2016 because you think, oh, there's markets, the markets are cyclical and this is the next wave is coming. This is one way of seeing it, but you have to look at things from above and look at what's happening outside of real estate. And that's what I think, coming from a different industry, it gives you that perspective. Look at all the millennials. It's millennials and baby boomers. Baby boomers are moving out of their homes. Maybe they're going to go to condos. Maybe they're going to rent an apartment. Millennials are moving from state to state based on the job that they're getting. They don't want to be tied up to a house and not move anywhere. And when you understand what's going on, when you see the shifts in, where companies are moving to, Austin, for instance, the DFW market, Atlanta, all those markets are in the Carolinas. They're attracting people. There's demand in those markets. Yes, the cyclicality of the market will impact the market in general, but more markets than others. I remember a conversation I had with someone back in 2018, and I told him, listen, I think Atlanta is a great market. And the answer that I got was, I remember times when I bought, units at $40,000 or $30,000 a door. I'm never going to pay $70,000 or $80,000 or $90,000 a door. We way past that. And I think sometimes it's a little bit hard to get out of your shell once you're too much kind of entangled in your own story. This is one way of seeing it, but you have to go a bit above and look at the bigger picture. Look at the economics. Look at the economy in general. Look at the fiscal economy. Look at a fiscal policy. Look at the demand, the internal migration within the U.S. You have to just read the map. Read what's going on, and then decide if this is the right time, to invest. A lot of, hindsight is 2020, but just looking at real estate and not taking a few steps from above and looking at it from 10,000 feet, you're going to miss a lot of opportunities. You can also miss a lot of, red flags. And it's really, really important to understand where you live and what's going on in the with the economy, with politics, before you make any decision.
I had something you said reminded me. I had a client once tell me that you have to have amnesia to buy apartments.
That may be true. That or it'd be crazy to do this because it's doing the same thing day in and day out, right? And trying to fix
if you've been in the market problems for more than 5 years, you've missed out on a deal, and that deal comes back around. You can't think about, well, I couldn't get it at 60 a door, so why would I pay 80 a door? Well, maybe it's a good deal at 80 a door.
Well, I think you also have basis is one thing, right? So it's, if you look back 5 years ago, we sold new construction deals in some of these markets in the Carolinas for 70 a door. 70 a door, you're not even buying like a C-class apartment in most of the markets in the Carolinas now. So, you have to look at where construction costs are. And I think that the basis is going to continue to go up, especially as wood goes up. And if wood comes down, then concrete's going to go up, or labor, it's always something's going to be higher than where it was. So it's all relative, and the deals just have to make sense. And you have to push down, as that happens, you have to push down investor returns at some point. That's what we've seen from 2012, where you're getting, 12% cash on cash. That doesn't happen now. And if it does,
can't find those deals.
Yeah, that's a great deal if it happens, but it doesn't happen anymore. So it's just, you have to grow with the times. And I think a lot of people just don't want to grow with the times. But it sounds like from your outside opinion and look, and that looking glass that you have, you're able to adjust and make probably more educated guesses on if it's going to be a good deal or not.
That brings up another good point. How are you managing investors' expectations as we're talking with pricing going up? And I'm sure you've had other real estate investors that invest with you that, as the markets everywhere, whether now in the Southeast or cap rates are compressing, how are you managing those expectations?
I'm being upfront with them. And when I speak with either new or existing investors. I say, hey, whatever you saw a year ago, there was nothing going on in the market, but whatever you saw 2, 3, 4 years ago, we're in a different market. Cap rates have compressed since COVID started. Pricing is up. It's managing expectations is just by saying, in order to make a deal, to get a deal, we're talking about, let's say 6 to 7% cash on cash. I cannot give you 8% because there's always going to be the guy that is going to make an offer based on a 6%. So if you're looking at 8%, you can just sit on a sideline and wait and not get a deal. And that's 6% is not great as 8% cash on cash. 13% IRR, 12% IRR is not as great as 15% IRR, but it's better than zero. And so that's one way of educating investors. And I also have on my Ready to Scale podcast, I have the High Achievers series, where it's just me speaking and sharing, what I see from my point of view, sharing it kind of the behind the scenes, from a sponsor's kind of a day in the life. And I shared it with listeners, and I said, things are changing. Here, let me tell you what I see as a buyer and as a seller in the multifamily market today. We see more deals, fewer deals than we normally see around Q1 of every year. Cap rates have compressed. The financing is not as good as it was. LTVs are down. So that leads to lower, returns, and still low. They're still pretty good compared to other alternatives. And if someone says, hey, I would like to invest with you, but I'm looking for 9 to 10% cash on cash, I'm honest with them, and I say, I don't think we're a good fit. What you're looking for is either highly speculative, highly risky, or someone, if you're looking at a deal like that, it's either the deal of the century or someone did not do their underwriting correctly, or they're being very aggressive. And really the gap between Class A and Class B and new construction and development, new construction / Class A, Class B, and development is not as big as we've seen. So I remember years ago, and I'm buying Class B assets, and I'm also looking at Class A assets. I've never done development, but I'm reviewing deals from other sponsors just because I'm also a passive investor myself. And on all my deals, by the way, and also with other sponsors, I used to see 24, 30% IRR on development deals. Right now, we're talking about 15, 14% IRR. So why take the chance and wait a year and a half to get cash flow? I'm just going to go to new construction. Maybe it's a Class A. We're in lease up, 25, 50% occupied. I'm going to take the hit for a few months, but then, valuation is going to grow tremendously because I'm going to bring the property from 50% occupancy to 95. I know how to do it. I have the right team. I can execute the plan. That makes more sense to me, but you can never know. Things can change. But right now I don't see a huge difference between the different, asset classes, which is interesting.
I completely agree with you. And I think that looking at even new construction lease up like you're doing versus like a 70s vintage value add, the cap rates aren't that different. And to me, if I'm an investor at this point where we are, I think I'd rather take the lease up risk because that somebody has done a ton of homework, and it's not just one developer, it's their equity partner, it's the bank, it's the management company. So you have all of these intelligent people that have done a ton of homework, or you're buying a 200 unit 70s vintage value add in Charlotte or Atlanta, and you're banking that you're going to be able to get a $150 increase with some a lighting package, granite. It's a difficult turn, in my opinion, right now where we are. Not to say that there's not deals out. Not to say that there's not deals out there and that that business model doesn't still work. But I just think that the development side or the new construction side, there are more opportunities right now.
Yeah. And I think also location plays a major role here. So I would not touch, new construction or actually any asset class in a weak area. If you're looking at a good area and strong area and you're looking at, a lease up deal or class B, you have, your risk is more moderate because that the tenant base can support it. It's an area that attracts the right type of people. But, if you ask me a B asset, a B class in an A area versus lease up in a C area, I would go with the location is everything. And I think we can see it, right now during COVID, the stronger locations, they're just, the operations is stronger. The rent collection is higher. I would bank on location every time. This is, location. If the location is not good, I don't even look at the deal. We have that really defined process where my analyst we have one analyst that does just the first screening. Every deal, he looks at household income, median household income in 1, 3, and 5 mile radius. Is looking at poverty, level. He's looking at crime. There are all kind of crime scores on property crime, violent crime in the city and in that specific area. Looking at home prices. So if we see that the area is not good, even if it's lease up deal, this is something I'm hesitant on touching and moving forward. Those deals I'm not going to touch unless there's like a fire sale and it's 50 cents on the dollar. But we don't see those deals. We thought that we were going to see those deals. We can't see those deals. There's no discount.
No.
Do you have rigid guardrails that you follow when it comes to those metrics, or is it just sort of kind of a guideline? Or if they're not, if the 1, 3, 5 don't hit where you want to be, it's immediately disqualified?
Normally it will be disqualified, but we know the areas. So sometimes maybe it's close to a university and students don't have income, but it's a really, really strong area. Then of course this is a rule of thumbs, but there are always exceptions. There are always, the story needs to make sense. Very hard to convince me that this is a good area if the crime rate is very high. You maybe can change the population and attract, other tenants if you also have, tech hubs somewhere. But unless you buy multiple assets in the same neighborhood, it's really hard to change the crime. So, to your question, these are guidelines. And if there's a good story there, then we may move forward. But for the most part, a low household income, high crime, we're disqualifying, the opportunity. And that's why we're looking at multiple metrics. So if, for instance, you see high crime, but average, home price $500,000, we're missing something here, right? And of course, I know also the areas really well, but there's always kind of pockets that I'm not familiar with. Right. So when you're basically looking at different metrics, if one doesn't agree with the other, there's discrepancy, then you're asking why, and you're diving a bit deeper into it. We're also looking at diversification in terms of employment base. So areas that are heavily reliant on tourism, we're still right now not moving forward in those submarkets.
Multifamily Method is powered by Capstone Companies, the largest privately owned multifamily investment sales brokerage nationwide. Capstone Companies provides dedicated coverage to both primary and secondary markets throughout the Southeast, Mid-Atlantic, and Midwest regions of the United States. Whether buying, selling, or refinancing, Capstone Companies is here to help. Simply put, Capstone is expertise, experience, extra mile. If you're interested in having Capstone provide a complimentary opinion of value on your multifamily asset, please visit us at capstone-companies.com.
Let's jump back. I mean, we've touched on it a little bit with COVID and no discount. What was your year shaped like last year as soon as COVID hit and kind of coming out of, I think seemingly we're at the tail end of it. So what was the portfolio that you have? How did that operate? Your acquisitions, any dispositions? What did that year play out like for you?
We didn't see many deals, unfortunately. Last year we actually closed. We were buying assets, but there weren't many deals as much as we wanted, and we got overfunded on the deals that we closed because we didn't, there were not enough deals out there, and we always have, and we get overfunded on every deal. Demand, investors' demand is greater than the assets that we can provide, which is why we're growing the teams and we're looking at other markets and we're actually expanding. In terms of operations, for the most part, we did pretty well. Especially the Atlanta market, which is why I'm so glad I bid on Atlanta. We had rent increases. The highest one was 29.4%, which I know sounds imaginary, but anywhere from 9% to almost 30% rent increases. We maintained high occupancy. At one of our assets, we had a dip in occupancy following, around March till June, and we brought it, back up pretty quickly. But collections were high. I would say 95 to 99% month over month. The main pain was not having enough deals in the market. Everything froze. The only deals that I've seen from March until July, I would say, were, C assets and C areas, really assets that were struggling before COVID, and now they had no chance. And it wasn't something that I wanted to take on. At first, nobody really knew what we're facing, what we're dealing with. But we did close, we were still buyers last year, and it turned out to be great. And I wish we bought more. I wish there were more assets. So
that seems to be the case for most. And from our perspective too, I think the majority of the deals were deals that were struggling beforehand, and most likely needing fresh capital, major deferred maintenance, things like that. Or people just got spooked. And Tyler knows some guys that they got spooked and sold everything. And now they're kicking
big mistake.
Themselves.
Yeah. If they just held on a little bit longer, sold it now.
The only deals that really got done were deals that were under contract, and you were able to drag them across the finish line with patient sellers and motivated buyers, I guess. If they really wanted the deal and everybody kind of worked together, you were figuring out a way to get it done. But that's really the only deals that got done from, like you said, March to July.
I hope they call you every day to say thank you, because if we try to buy this asset now.
Yeah, no kidding. I think one thing you've touched on is the organization of your company. So it leads into, a topic of conversation that we like to have, and that's what your current day looks like for you. To me, knowing you have an analyst that all they do is vet the first round, like when a deal comes in, that's what they vet. Like, what are you doing on a daily basis? I know you're talking to investors every day, but aside from that, are you on site at properties, or do you have somebody for that? What does it look like?
Every day is different. So I'm either flying out to walk properties. I usually fly out once I know we're in best and final. Before that, we just send our property management company to tour the property. So once my acquisition manager recommends we move forward with a deal, we sit down and we look at the numbers, because I don't even look at a deal that doesn't even pass through that first underwriting phase. And so if we're in a best and final, then I'll fly out there. I'm probably paying too much for airline tickets because we have 5 to 7 days to submit our final offer. And I have a day or two to book a flight to get there, walk it, go back and discuss with my acquisition manager. And so it's either flying to see deals or making surprised or scheduled visits to my other properties to see that everything is fine. Between that and speaking with investors, speaking with family offices and institutional investors that are interested in investing or that have invested, and we're kind of doing some sort of a recap. Being on, podcasts and speaking at events, and of course, managing the company. So meeting with the marketing manager, meeting with the investor relations director and discussing the plans and, what strategically are we doing to bring the company to the next, level. So it's a combination of speaking with investors, visiting properties, and managing my managers to make sure we're pushing the strategy, we're executing on our plan and growing the company.
What is that growth plan? Where do you foresee yourself, in a year, 5 years? What are those goals?
The ultimate goal is to become a $10 billion company. And we're actually on track to get there. I'm hopeful that we will, not only achieve the goal, but exceed this goal. But that's basically the goal, which is why the money that I'm making is being reinvested in the company. I'm not worried about making $1 today. It's all about growing the business and pushing it forward and investing in branding, investing in the operations, making sure we have the best asset management team, making sure we have the best team to take care of investors and the best team to handle acquisitions and dispositions. So basically, focus on growing the team so we can hit our 10 billion, target. That's the target, for the next 10 years. I'm not there yet, so don't be impressed. Be impressed 10 years from now when we're going to have a conversation. I'm going to tell you that I made it.
You're allowed to celebrate the little victories.
That's right. Hopefully you'll still come on
how to do it.
Still come on the podcast when you're 10 billion AUM.
So I know you're in Atlanta. What are your, 5 target markets or however many there are really that you want to be invested in? Because you're talking to 3 brokers on this call, and probably 30 more that are in our firm are going to be hopefully listening to us when this gets distributed. So tell us where you want to be so we can help you get to that $10 billion valuation.
In the Carolinas, I would say mainly Charlotte and the Research Triangle. These are growing, markets that I'm extremely interested in. Of course, you have Atlanta, and then Austin and DFW. And then in addition, I'm also interested in Tampa and also in Phoenix, Arizona. So we might grow beyond those markets, which is why I'm hiring more people so we can expand to other markets, but they have to be markets that are landlord friendly and that, mainly attract companies and attract people, because where people go, I want to be. I want to be in those markets because that's what's going to create the demand for multifamily. So I don't want to be in a market that the population is kind of flat. I want to be in the market that keeps attracting companies and individuals, over time. So I know the more people arrive to that market, the more companies are moving to that market, then the higher the demand would be for my assets. And I know that right now interest rates are kind of increasing, which really sucks when it comes to financing. But it's also great because you have tenants that cannot buy their first house. So they have to stay and keep renting. So you lose on one side, but you win on the other. I
think as we see rates go up, we might see a little bit more deal flow as some of those prepayment penalties from those loans that were originated 3-4 years ago start to get a little bit less punitive. You might start to see a few more owners look to sell when that prepay goes from 2 million to $1.5 million.
So this is outside of work, right? What is something that you're working on that you're passionate about? It's a passion project. Do you have anything? I mean, it sounds like you work nonstop with everything you have going on and the goals.
Yeah, I don't have much time for, other things. I can't say I'm an avid skier. I love to ski. I only started skiing when I moved here to the States. So I moved here when I was 32 years old and started skiing. You can imagine how it went. Not very well. But I'm actually skiing black diamonds and I enjoy skiing. I wish I had more time to ski. And this year I skipped skiing because of COVID. But I'm also, I'm passionate about educating children from low socioeconomic backgrounds, and I have a charitable foundation that is donating to this cause, among other causes. So that's something that I am passionate about. And I have to be honest, I'm sitting here in Providence and I really want to improve this city and make it more vibrant and more attractive. And I have a lot of ideas on how to bring some brains from our neighbor, Massachusetts. You have all the brains there, a lot of startups and biotech companies, Harvard, MIT. We need to somehow to bring them, over here. So I don't know if I'm going to have the time for it. I'm happy to hire someone to help improve what's going on in Rhode Island. But in terms of, actual passions, I would say between, my charity and skiing and of course running Blue Lake, that's my number one commitment and passion.
What's the name of your charity? Just so we can let everybody know.
It's called the Ben and Ellie Charitable Foundation. It's just named after my husband and I. It's not. It's a foundation that basically moves money to other charitable organizations. And we started it by just taking all the money that we got when we got married and just started the fund this way. We thought, hey, the first thing we do as a married couple, we can do something that actually, means. And I think you kind of have an obligation, almost have an obligation to give back when you have enough. And I wish someone, helped me with some alternative education about financing and entrepreneurship when I was young. Probably I would get to the $10 billion company much faster. So
it's impactful. That's awesome. So you went from learning to walk on snow to skiing double black diamonds. I don't want that to get
not
lost.
Double blacks.
I
was doing a very, very slow and unimpressive skiing on a black diamond. By the end of my third day learning how to ski, it was the scariest thing that I've done. But when you're done doing it and you look back, I remember the feeling of being amazed. I just did that. It took me forever, right? It wasn't impressive, at all. I almost quit the first day because I was really the lamest, slowest skier in the group because my husband put me in, he was basically saying, I'm going to put you in this class. And I said, I don't do classes. I want to learn on my own, but it was not an option. I said, okay, fine. You go have fun with your friends. And I was so slow. It was really embarrassing, but by the beginning of the third day, I really improved by pushing myself. And I think with A players, when they don't perform, it's really embarrassing. They don't know what to do with it. And I didn't know what to, there were, much younger people in the same group that were doing so well. And, they were in the ski school. And I felt, it was kind of embarrassing and uncomfortable, but I'm glad that I pushed myself.
Yeah, you got to push yourself.
It was amazing. Yeah.
Got to get outside the box. That's awesome, though. Let's move on to some rapid fire questions. I think these are just little nuggets that everyone, I think, is interested in. What's the best book that you've read that's impacted you?
Right now, I'm actually reading a book by Steve Schwartzman, the founder of Blackstone, called Whatever It Takes. Amazing book. Very, very, I may reach out to him actually, but very insightful and inspiring. about how he started in Wall Street and how he broke out of Wall Street and started Blackstone, which was fascinating to me because it was a hot minute in back at MIT that I wanted to be an investment banker. That didn't happen. I remember one of the managers, I think it was JP Morgan, one of the VCs of JP Morgan called me to explain why he did not accept me to his program, because it was a very rigorous and long kind of, process. And he said, I have to tell you, I don't think you really want it. Call me a year from now, if you still really want to be in investment banking, we can talk then. And I realized that I didn't really want to do it. I wanted to be an investment banker because it was hard to get in and I like the challenge. I also need to reach out to him and say thank you, because I am where I am today because I didn't take that opportunity. But he was a really, real smart guy, and he realized that that was not for me. So I think he was, it was a vice president. I said a VC because I have VC in my mind. I think it was a vice president of I forget what, part of, the bank, but it was another no that turned into be, wow, that was a really good thing that happened to me.
I'm going to go a little off script. What is the one thing in the U.S. that you don't have in Israel that you appreciate the most, and what is the one thing that that is in Israel that you can't get here that you miss the most?
What I have here in the U.S. is just a convenience of getting things done. So, you want to get somewhere, you don't need to wait for a cab. There's an Uber. You want someone to pick up your dry cleaning, because I don't do a lot of house chores. Just you have an app, you click, they come pick it up. It just things are really easy. One thing that I have in Israel that I don't have here, I have to say, I think Israeli food. I really miss that. Yeah. What's your favorite dish? There are a lot, but there's some soups that I like and hummus and other things that I really enjoy. And it's really hard to find here. I actually have to drive for an hour to Boston to find something. It was easier when I lived in LA because you had a lot more Israeli food, around, but that's one of the things I miss. I was born in Beirut, so I'll make you some hummus and send it up to you. How about that?
Ellie, as an avid skier myself, I've got to ask some of your favorite places to go ski.
I like all-time snowbird.
I love spring skiing there. I was there last April. It's great.
I guess what's one piece of advice that you could give either to someone or your younger self?
Just keep doing what you're doing. Don't overthink. Act. You're going to be fine. I would whisper that in my ear. Just keep doing what you're doing. You're fine. Act. You're going to be fine. That's it.
Right.
Yeah.
What's the one thing you would go back and change if you could in your career? Nothing. I never look back.
Well, is there anything else that we missed or that you want to talk about?
No, I think we covered pretty much everything. It was fun. I was never on a podcast with three interviewers, so that was interesting. Kept looking around the screen, to find who's speaking. But yeah, it was fun.
Yeah, it was fun for us as well. It was definitely interesting, very entertaining. Great to hear, your background and history. I mean, it's nothing but impressive.
Thank you.
Yeah, it's a great story. We're happy we could share it.
Yeah, Ellie, we all really appreciate you joining the podcast. Thank you.
Yeah, absolutely. Thank you so much for having me.
All right.
And go ahead and plug your podcast since I know you mentioned it a couple of times, but while we were talking about if you want to go ahead and plug your podcast or whatever else you'd like people to come check out.
Yeah, it's called Ready to Scale. And actually, if you Google my name, Ellie Perlman, then you can easily find my website and my blog and my podcast. Everything is there. So that should be pretty easy.
Thank you for listening to Multifamily Method. If you enjoyed today's episode, please give us a rating and a review on Apple Podcasts. It helps our podcast get discovered by other savvy investors like yourself. Subscribe to Multifamily Method for free on your podcast platform of choice. Find out more about Capstone Companies at capstone-companies.com. Multifamily Method is executive produced by Capstone Companies. Audio production for the podcast provided by Andy Go of Gojo Studios, and video production by Yash Mystery of Mystery Projects.